Hey, what's up, everyone? Welcome to another Wealth Webinar Wednesdays. Today is going to be all about how to solve the problem of being house rich and cash poor. Can anybody relate to that? So we're going to get into that today with the guys from CMG Mortgage. They were with us last week, Harrison George and Greg Conley. What's up, guys? How are you today?
Hey, how's it going, Steven? Thanks for having us on here again. Appreciate you guys.
Yeah, absolutely. I put it over in gallery mode for just a minute so we can see everybody, all the panelists on the show today. We got Joseph K, known as Mr. HELOC here at the BYOB Money Multiplier. And of course, the freak in the sheets himself, Craig Yenny, is out there in Cincinnati. They're at the Cincinnati Tennis Open right now, sitting up in one of the sky boxes with the Lafayette Life Insurance Company suites, and they're out there meeting with executive leadership over the last couple of days, improving our relationship so we can continue to bring you guys the absolute best, specially designed and engineered whole life insurance policies that you can use to become your own bank. And practice the infinite banking concept. So today, however, we're not going to talk too much about IBC. We're going to take a step back and we're going to get into how to take advantage of the equity in your home, different way to kind of look at this, and how maybe you can possibly really boost your banking system, your infinite banking policy, and what that might look like. So we're going to dive into that a little bit today. But before we get into it, Harrison, I thought maybe we could just start with kind of some of the basics.
Yeah,
Last week we like jumped right into it. We have a
yeah.
lot of we have a very diverse audience on here. We have a lot of people that have been around the campfire. They understand a lot of the terminology. Maybe they've been studying money and investing for several years. We also have a lot of people on here right now that are brand new. Maybe they just heard about BYOB. They're just starting to learn how to take back control of their money, financial education, alternative investing. So we have some basic terms. So anytime we mention anything about BYOB or IBC today, we're talking about the infinite banking concept, which flatly put is a way to flow money. It's a different way that money flows. And what we do is we use a specially designed and engineered whole life insurance policy to take advantage of uninterrupted compounding tax-free guaranteed returns for the rest of our life. Now, we'll share a video in just a moment where you can go after today's webinar if you don't know anything about IBC yet, and you can learn all about it on one of our on-demand videos. We have a whole bunch of them, so we'll share that with you in just a moment. But that's what this is all about, is taking advantage of that uninterrupted compounding interest. And the power of IBC is the fact that you can simultaneously, while that money is guaranteed growing for you in your policy, you can borrow out and get that money moving for you in other places. Things like paying off debt, where you can pay off your debt a lot quicker than otherwise possible while still building wealth. Use it for things like major purchases, vehicles, or my favorite, taking the money from a policy and putting it into real estate deals, private lending deals, business deals, and growing our wealth in two places at the exact same time. And like I said before, what you're going to learn today is a way to really, what was the word for it, Joe? Really hyper get that thing going, like get that policy and explode it at the very beginning. Different options and different ways to look at money. So that's what we're going to get into today. So a couple other terms. We're going to talk about real estate. So when we talk about equity, equity in your home is basically the value of your home minus what you owe on that property. So if you have a mortgage, like a lot of people have mortgages, let's say the home is worth $200,000, you have a $100,000 mortgage, that means you have $100,000 in equity in that policy or in that property. And a lot of people don't realize you can tap into that equity and use it. The most common way that most people on here right now have probably heard to do that is through what's called a HELOC. So a HELOC is a home equity line of credit. So it's a line of credit that's basically collateralized by your home, and it's based off of the amounts typically based off of the equity that you have in that home. And it works like any other line of credit. But what CMG, Harrison, and Greg have done is they've created a way for you to combine your mortgage and your HELOC essentially, along with everything else you're doing in your financial life, into one product. And that's what we're going to talk about today in the all-in-one mortgage. So I just want to share a couple of those kind of basic terms. Harrison, Greg, are there any other things maybe we should set up now? It's like a glossary of terms that we should mention real quick. What do you guys think?
I mean, you kind of hit the nail right there on the head. Appreciate you kind of giving everybody a little bit of a breakdown on product is. So yes, it is the combination between your mortgage and a HELOC, this line of credit, but actually more importantly, it's also your checking account. This is the account that your income goes into. This is the account that your expenses go out of. You used the word hyper just a second ago. When I talk about this product, we use the word hyper efficient because even in the times in which you're going to spend your money, you are still letting that money work for you. It's just sitting somewhere else, your bills or so on. So you kind of hit the nail on the head. HELOC is also, a shorter term for home equity line of credit. Greg, are we missing any other acronyms or anything that we need to be aware of on this product? I mean, we call it the all-in-one or AIO.
We talk about a sweep account, how a sweep checking varies from a regular checking.
Yeah, absolutely.
So
And I don't want to get too far ahead of us. So I think Harrison will kind of get into
great.
that a little
Yeah,
bit. So
we'll get
something to
into
look
it.
forward to here
Sure.
on today's webinar. And then, of course, Joseph Kovacevic is with us, Heloc Joe, and he's what really takes what Harrison and Greg do with these AOI, all in one AIO
Yes,
mortgages, and
AIO.
it combines it with IBC. And we'll get into that, if not later today, definitely more so next week. But I want to kind of take it back and let Harrison kind of really go in deep on how these all in one mortgages work and really try and just simplify it because it is a very powerful tool if used the right way. And a lot of people have never heard of it before. So, any of you that are on right now, if you own a home, if you own investment properties, if you're looking to own properties in the future, this will be very, very relevant for you today. If you don't own a home right now, I would still pay close attention because we are going to get into some other ways to buy properties, possibly things you could take advantage of in the future, things like that. And we will talk about other topics as well that will definitely be relevant as well. So, with that being said, Harrison, we can kind of turn it over to you. I know you prepared some different slides to get things started today, and we'll roll from there with it.
Yeah, no, that's beautiful. Beautiful. Well, thank you guys. Appreciate you guys giving us a little bit of time to walk you through. We're going to pull this thing way back. This is going to be bringing it back to elementary level, which is often how I have to talk to Greg together. So I'm going to keep it real simple for everybody.
He goes very
Um,
slowly,
yes.
slowly. Yeah.
Yes, exactly. So
Yeah.
the all-in-one kind of starts with something very important to not only myself and probably every single person on this phone call, but probably the birthplace of net worth, which is going to be your checking account. Because for the most part, every single dollar that any individual earns is likely going to land from their employer or wherever they receive it from directly into their checking account. A really not well-known fact is that over the course of 5 years, more money will pass through the average household's checking account than the balance that they owe on their home, if they do owe money on their home. However, the thing that most people don't realize is that they don't make anything on that checking account. Yeah, you might be lucky, you might make 0.01%. Heck, you might be in the 0.01% and make a quarter of your checking account. That money just sits there doing almost nothing for you and doing everything for the bank. Now, the benefit of having the money sit in your checking account only falls onto the bank's shoulders, not really onto your shoulders, because while you're waiting to pay your next bill, the bank is leveraging your lend you that same dollar for your next credit card expense. So it's really just kind of a system of the bank providing education or standard bank education to individuals on how they should pay their debt off, maybe so it not benefits you, but is perceived as benefiting you, benefiting the bank because you let your paycheck or your bills roll from one month to another month. You're just paying them a bunch of money in interest, 33 to in interest. And so having money sit in your checking account doesn't really do anything for you. It does everything for the bank. So that's the concept of where we want to start with. Think about your checking account, and there are so many different avenues that your checking account doesn't have access to do. Now, all-in-one product takes advantage of that checking account. So instead of your money every single month just sitting in your checking account, waiting to pay your that money, lazy money, is going to be put to work. Instead of it being in your checking account, it actually gets swept with this product physically without your influence, other than in Texas, and there's just small level of regulations there, but I can get into that later. Uh, Automatically moves from your checking account while you're waiting to spend your money into your mortgage balance. And that's kind of the benefit, this sweeping function of this product that allows for people to take hyper efficient use of their mortgage. Now, as they earn their income, it goes into their bank over here. Wells Fargo, Chase, etc. We are going to be changing this bank to this institution that we partner with, and that money is going to sit in your checking account until 11:59 every single night. So when you earn money, you'll into your bank account, you'll see your checking account and you'll see your line of credit. At the end of the day, all this does, this checking account does, is it sweeps money from your checking account against your mortgage balance. You still have access to it. It's just taking advantage of this account and the usage of your money moving from your checking to your mortgage. And the reason why we like to do this is your payment on your home is only based off of what you owe in this product. Whereas in a 30-year mortgage, it's based off what you borrow. So for example, look at this in most likely every person scenario right now. You guys bought a house during COVID for $300,000 or $400,000. That home's now $500,000 or $600,000, and you have a $250,000 mortgage. Well, your mortgage balance at the time might have been 300,000, but now you owe 250. Your mortgage payment has not changed. And in many instances, it's possible that your payment has actually gone up. Now, that's likely because of taxes and insurance, but you're always making payments based off of what you borrowed at the time that you closed on your home purchase. Throw that concept out the window. This flips it on its head. As you balance down, your payment is only going to be based off of what you owe. So you could imagine that if you owe 300,000 and now you owe 250 and your payment has changed by $400 or $500 from where you started to today, that $400 that you're not spending anymore, some inherent new expense. You're not going to go one day, oh, we're saving $400, so let's go put $400 towards groceries or to dinners every single month. Most households, most people, when they're saving a dollar, aren't increasing their expenses for every dollar that they save. If you do, maybe this product isn't the right one for you. And maybe there's a mindset shift that we can change with something like that. But for this product specifically, as you're saving more money monthly, that means your mortgage balance is going down at a faster and faster rate. Hyper efficiency use of your dollars. Obviously, as you earn your income, because everybody here is likely receiving funds from some sources. Realistically, every dollar you earn is just going to go towards your mortgage balance. Every dollar that gets applied to your mortgage balance is adding equity to your home, equity that you have access to use to apply towards any of the investments that Joe or Craig or whomever else is providing guidance in your life, or even that you come up with and invest into. Now, obviously, don't just start throwing money every which way you can. I think that there's some math that needs to be involved, and obviously the guys on this phone call are phenomenal at providing that math. We get a lot of questions about how's the interest calculated. Interest is simple interest, and in fact, almost everyone can do the interest calculation on this phone call. We make it a little easier when we pull up a calculator, but all this is doing is it's taking your balance at the end of every single day, multiplying it by the interest rate, and then it divides it by 365. So realistically, you can do this calculation on the first day of the month to the second day of the month to the third day based off of your balance. The easier way of doing this is just take your approximate mortgage balance, multiply it by your interest rate, and divide by 12. Now, it's not perfectly accurate, but it's good enough to give you a general understanding on what that payment would be at. It's not, it's,
Harrison,
yep, yeah.
why why doesn't the bank do it that way? Why doesn't the bank divide it just by 12? Why do they specify out on a daily basis? That seems tedious. Why would the bank do that?
I mean, so the banks really, so the benefit to the bank in this program isn't necessarily the total interest that they make, like a 30-year mortgage. 30-year mortgages, I think every single person here should take a look at their amortization schedule on their mortgage. You guys will spend about 27% of total interest in just the first 5 years. So the benefit of the to the bank for a product like this is that you're currently over here on the path to spending $400,000 in interest that the bank isn't receiving. Yeah, well, if they had your mortgage, they could receive that money. Well, they want to provide this product to help people get out of debt because they know that when people get out of debt and they want to better their lives, it comes with finding other financing solutions. I want to start a business. I need to buy a vehicle. I need to go to school. There's other ways that you can build a relationship with these individuals that go above and beyond just doing a 30-year mortgage. So the reason why the bank utilizes a program like this is to provide benefits to the consumer, because we and the bank and most people in business believe that if you do a good job and that job, you save somebody money, we're confident that that's going to bring that business back. And that's kind of the main reason why we have offered this product. Hopefully that answered your question. Again, we talked about it just a moment ago. So obviously, while you're putting your money into your account, it's just sitting against what your balance. A lot of people say, well, why I could do this with a normal 30-year mortgage. Why don't I just apply extra money towards my normal 30-year mortgage? And my question to you would really be, why aren't you applying it towards your 30-year mortgage right now? Yes, you could, but you're just locking up all of your equity in the home, and then you need to pay to have access to it, and it's not reducing your interest expense. It does reduce the total amount of interest you pay because you pay your home off faster, but you're not seeing any of that. It's not bringing you any closer to hopefully that next goal of paying off the other debts and building up a little more of a generation, not only you and your family, but your kids and your kids to come. So this is kind of a concept and a proven instrument that realistically allows for people to build wealth and maybe do it in a way that allows for them to achieve it faster. And I think that that's just a really amazing concept at the end of the day, is that I'm patient. I want to have the things that I do happen as fast as possible. If I can turn my goals from 5 years into 3 years, or from 3 years into 2 years, saving time, and I'm building something that otherwise I wouldn't have been able to do in this limited amount of time I have. This loan, at the end of the day, this line of credit is a 30-year line of credit. It gives you access to the total amount of equity in your home of 80% for units. $500,000 value, $400,000 line of credit. If you owe 100 grand, you have access to $300,000 right out of the gate. That total line of credit is only going to be available. Well, the line of credit's available for 30 years, but the total amount, that 400,000, is going to be available in years. The remaining 20 years, that line of credit you have access to will decrease over time. Now, yes, I think we mentioned this last week, was talking at year 9, you could just refinance this and your value is 900,000 and take advantage of the higher line of credit. But this is just a way for us to get the loan amortized, which is why you're still going to receive this 1098, this mortgage interest form that you can then utilize on your tax returns to write off that mortgage. If you don't itemize it, and I'll let a CPA get into all of this, right now, if you went to go buy a motorcycle, you can't do anything with any of the mortgage interest cycle if you got a loan. However, if you paid for the motorcycle through this product from your equity, and now you're paying interest on that increase of mortgage balance, write off that mortgage interest and not need to indicate that that money was utilized for a vehicle or a motorcycle or so on. A little more granular data about what you would have access to at what time frames, kind of in a very specific way. Now the bank account. I've blocked out a lot of this stuff because I think that there is some personal information here. There's 2 different banking institutions that we partner with. I'll let Greg is in a second, but at the end of the day, 2 banking institutions we partner with are going to be Merchants Bank of Indiana, and then there's another one called North Point. Greg has a North Point one, but here we go. So this is my checking account and this is my mortgage. Clearly, I'm blocking out certain information. My check in this picture is showing that we had a bill come out of our checking account for $657. It shows a negative balance. Balance before in the previous day was $0. What this does is that when I or my wife go to pay a bill, we want to pay money from our checking account to our Wells Fargo card, let's say. It pulls money from our line of credit in our loop down here and puts it into our checking account. It's putting it into a checking account as a negative number because that money is being sent out. If that money was coming in, this minus sign would no longer be there, and we would have a $657 deposit in our checking account. It would remain there of the day until 11:59 tonight, where it would then go to 0 and our mortgage balance would go down by the $657. So when you get into your account, it's really very simple at the end of the day. You have this checking account that usually shows a balance of zero, and then you have your mortgage, which you want your money sitting. It's sitting against the balance of your home. Obviously, you have the ability to go into bill pay. You can move money with Zelle, look at your different accounts. You can transfer money from one all-in-one to another all-in-one. Just you have mobile deposit, everything you have currently with your bank you have with either of the banking institutions we partner with. If I had my debit card, which I guess I don't know why I'm searching for it because I shredded it, because every time you use your debit card, uh, it's adding a balance to your mortgage. So to take advantage of the bank's free money, you can utilize cards that give you points. And as long as you pay those off at the end of every month, you can be really efficient with how you utilize these accounts. But if you did keep the like me, you can go to any ATM anywhere, and yes, it'll charge you that $5 surcharge. All you do is you come on here and you just request for get upwards of 5 reimbursed ATM withdrawals on a monthly basis, which at the end of the day, I don't know if I've used the ATM 5 times in the last years, but if you are an individual that needs to use an ATM, there are some solutions for you. I'm gonna let Greg take over because he utilizes the North Point Bank and it's very similar to what I was just explaining to you.
Yeah, thanks, Harrison. And just as a comment, guys, Harrison just showed the Merchants Bank of Indiana interface. That was his interface for his loan on his house. This North Point Bank interface is the interface that I use for my loan on my house. So when we come on here, we're not making something up that we sell but don't actually advocate for ourselves. These are our personal accounts because we believe in the product really, really strongly in the same way that all the gentlemen on this call believe in what we're advocating for and believe in what they're advocating for the betterment of everybody listening. So keep that in mind. Like as you're looking at stuff like this as a litmus test, do the people that are talking to you believe in it? And in this case, the answer is yes. And with this group, the answer is yes. So as Harrison was describing, you've got two accounts. You've got the all-in-one account on the bottom, and that all-in-one account shows a principal balance. That 449 is when I took this screenshot, what was owed on my mortgage. Connected to that all-in-one account is the sweep checking account that we've been talking about. And you can see in this screenshot, the current balance is $0, and that's by design. Every 24 hours, as Harrison mentioned, that account sweeps any amount of money that's in there to reduce that principal balance that I owe on my mortgage. So we can go to the next slide. This is a quick screenshot of the checking account itself. And what you can look at is it looks a little different from a standard checking account because there's what's called a reconciliation transaction. But other than that, we can track any sort of transactions that occur through a checking account. Now, I try to keep these to a minimum. As Harrison mentioned, most of the bills and discretionary spending that myself and my wife use are through a credit card because we want to leave as much of our money against our principal balance on our home as possible for as long as possible. So 90% of our transactions are using a credit card. There's a couple things, some life insurance, and some things that require a checking account that we use. But other than that, you'll see there's a Chase Credit ePay down at the bottom. That's us paying off our credit card for our monthly bills. So we make sure that we leave as much cash as possible from our income in this account and leave it there for 28 or 29 days of the month to keep the principal balance on the loan reduced. And what you see here, this is the all-in-one account. This is the mortgage portion of the account, right? What it shows is a principal balance. My payment that's due on the 21st of the month, that payment is based on the daily interest from July. So from July 1st to July 31st, there's a daily simple interest calculation for each day based on my principal balance. They add all those up and they spit it out, and that's my payment. Now, currently, I think Harrison mentioned this last week, we don't have any fixed intro rates because right now it doesn't make sense to lock an intro rate. I happen to have a locked intro rate from COVID that will be expiring next year, but I'm still really excited about my all-in-one loan because regardless if my rate is 3.75 or 7.75, the velocity of my money paying down the principal balance on my loan still makes more sense than having a 30-year fixed amortized product. Is it more attractive with the lower rate? Sure it is. But is it more attractive in general with a 30-year fixed product? Absolutely.
Beautiful. And so I'm actually going to kind of walk through a little bit of a simulation We really appreciate you guys giving us a little bit of a chance to kind of walk you through how this loan has this checking account, which is kind of like the lifeblood of this product. As that checking account is utilized, we are going to be seeing people utilize this account for debt elimination, for asset acquisition, and then at they're going to work themselves back into debt elimination again. So we run into this scenario all the time, and I do feel like it's probably something worthwhile to discuss is, well, what happens if I have a 3% 30-year mortgage? Should I do this loan? And I think everyone's going to say the same answer. It's going to be, well, yeah. So I put a little scenario together of the quintessential, I got my loan during COVID, I have a 3% 30-year mortgage. Because I think that there's plenty of people that ask this question, and we run into this question quite often. Should I refinance into this loan? Scenario we're running is, yes, it's my primary residence. I want to compare this all-in-one loan at today's interest rates to a 30-year mortgage at 3% that I months ago. I have a $500,000 home and I owe 280. Household income is $10,000 a month. They have the fund of $25,000 sitting at Wells Fargo. And then at the end of the day, this family is indicating, hey, we have a really low level to pay off some of our other debts. We save about $2,200 a month. Does this make sense for us or not? And I am going through this a little quick. I did put the simulation together so that you guys didn't need to hear me clicking my keyboard. But at the end of the day, this individual is going to be paying about 8.5 years, 8.3 years, 100 months. Whereas this person over here has 25 years left on their mortgage. So not only is the time value of money in the all-in-one on the left side 3 times as fast as the 30-year mortgage that they're in, they're saving $23,000 in interest. But what a lot of people don't really think of is that this household over here could still have been saving money and deploying it elsewhere. Whereas this household can do the same thing, but as things come up, as they perhaps add new kids to their family, or as they send kids off to, they need to get a new car, or they want to set up a policy, or they want to invest their money in something, this gives them the ability to do it without ever needing me more than once, or Greg more than once, because you have the ability at that point to say, great, I have access to 400 grand. You can achieve $400,000. In fact, I would say there probably isn't much you couldn't solve with a $400,000 check after 8.5 years to get that engine of your life, that next financial vehicle, that next investment, the whole life policy to build that generational wealth. Because although for me to build generational wealth, you have to tell us what your goals are. And the only reason I'm saying that is because I can speak from my own experience probably better than anybody else's. And so I'm just going to kind of walk you through my own experience. Obviously, this can be a very confusing amount of information, and maybe even more confusingly enough, if I go over here, we can compare a lot of the data to what a 30-year mortgage is. So for the interest rate we're running on this simulation is a 7.84 interest rate. That's the rate that we're utilizing for the entire life of the loan. Even though it's likely that over time, and we have been seeing rates over time come down on this product, we're using 7.84. So that also adds benefit to this number. But to compare this loan to today's numbers, you would need to get a 30-year mortgage in this simulation to an interest rate of 2%. So this is how we can say, here's how you can get a 2% mortgage today, even though rates are in the sevens and eights today. Because effectively, you would need a 30-year mortgage at 2% to be equal to this loan. Now, vice versa, you need the all-in-one's interest rate. It would have to go to almost 9% to be equal to a 30-year mortgage at 3%. We're just trying to show you, hey, look, numerically, the number's higher than where you're at now. Interest rate, but interest expense is the thing that I think most people look over, and is, in my opinion, the reason why 30-year mortgages are more risky. Yes, you have a fixed mortgage payment, but the interest expense over the life of the loan is drastic. How can we keep the money out of the bank's pocket and into your pocket? So I think on quite a few different things. Joe, is there anything that you think that I missed that could have been beneficial? Or Stephen, is there anything you think that I missed that could have been beneficial?
No, I mean, I thought you covered things Very well there. I'll let Joe if he has any comments, or Craig there.
No, I think it was a great overview, and we've got a lot of questions in the Q&A. I figured we could just address those live.
Oh
So
yeah.
maybe we just started going through some of those
Yeah.
and then we can continue on.
Yeah, absolutely. I can hit those and get some answers. But Joe, did you have anything you wanted to share?
No, he did awesome.
Great.
Beautiful.
Spot on. I was talking about this morning on what the F. Somebody was talking about Lafayette Life because I had mentioned Chris, you're up there, and they said, hey, tell them to lower their loan interest rate because it's been at 7%. But when Craig runs the numbers through the vault, it shows like a 5% rate from an insurance company, 7% when you're using IBC the proper way, because it's simple interest and you're paying yourself back like a honest banker. At the end of the year, it's not much of a difference, 5 and 7% on these loans from the insurance companies. And I know with the all-in-one, it's very similar. Nobody's always worried about fixed rate, or oh, it's variable. If it goes up, I'm gonna know. And the way you guys do this with the simple rate and the sweep account and everything, it's mind-blowing. It really doesn't make much of a
How
difference.
about this? I'll give you guys a fixed rate, but then when you come back and say I wish that I could have it lower the interest rate, that you just gotta promise you can't get mad at me.
Now, I know
What's
Harrison
interesting,
always looks good for the client, and that's what's awesome.
what's interesting about a fixed rate, guys, is that a fixed rate inherently, in terms of like interest
Thank you.
exposure, is not any less risky. It's just more predictable. And so the thing that you have to switch your mind to is that the risk is all built in and right in front of you on a 30-year fix. You're kind of getting screwed by the bank on a 30-year fix. It's right in front of your face in the amortization schedule. The thing that people don't like about the variable is that there's a little bit of uncertainty, but the reality is that if you can reduce principal at a rate that is significantly greater than your fixed rate, then you're hedging against any sort of unforeseen risk. And so if you can do that in a way that moves your principal down with a high degree of velocity, you're going to beat that 30-year fix every time.
I think one thing too that's really important to kind of piggyback on what you said, Greg, is the fact that right now we're coming off of a high interest rate cycle and we're moving into a lower interest rate cycle into the unforeseen future. So if someone were to lock in rates today, you're doing yourself a huge disservice because rates are going to be going down. I mean, it's very clear to see what path the Fed is going to take on the rates. And you definitely would want a variable. I think like what Harrison said, like, hey, I'll lock you in today, but don't be mad at me when rates start moving down because that's where they're going to go.
Well, let's dive into a couple of these questions because I know there's some really good ones on here. So Fern was asking, aren't we now allowed to tap into the entire equity? Isn't it limited by how much we make?
Yeah, so there's kind of two parts of the question. One, you have access to a percent of the value of your home. We order an appraisal, which you kind of want there to be an appraisal because most HELOCs, when if you've ever tried to go through the process of a second position home equity line of credit, they usually base it off of what the county assesses the value of your home. And the only thing that the assessed value does is determine your property taxes. So in almost every instance and facet of your home value existence, you want the county to your property as low as physically possible because then your property taxes are calculated off of the lowest number possible. So on the all-in-one for primary residence, yes, you can put 10% down on this property and get a line of credit of 90%. If you do a refi onto this property, you can go to 90%, but you cannot go to 90% as a cash out. And what I mean by that is if you owe much less than 80%, you could only go to 80%. But if you happen to owe 85%, then it's just going to cover closing costs and that's it. Second homes are strictly and investment properties are 70 to 75% of the value of your home. So there's just limits on, you can't get access to 100% of the value of your property. Now, the second part of the question is, isn't it limited by how much we make? Well, yeah. If you guys have a $5 million home and you only make $50,000 over the course of the year, you're not to a $3 million line of credit. You're going to get access to whatever the max line of credit that your income can qualify for. Now, that's obviously a very robust example, but yes, your income plays a part into this.
Cool. No Sheen was asking, is the all-in-one option available for co-op apartments in New York City?
It's a good question. I don't know off the top of my head the answer to that. That would be something I'd have to dig into. Harrison, do you know that one?
Yeah, so co-ops are not currently available in New York at the moment. It's designated. I mean, I'm guessing you're saying, hey, it's partially commercial, partially residential. No, that's not currently available. We are in the process of working through that. We're hoping that by this time next year, we'll have a solution for that. We're also hoping that this time next year, we have regular commercial portfolio loans, 4+ unit kind of apartment complexes, bank statement variants of it. We're working on personal lines of credits. We're working on credit cards from down here to as large as you can think of. We're trying to find a solution on how we can help people every step of the way.
Frenchie said, I'm doing a buy and rent property at 50% loan to value. How would an all-in-one benefit me?
When we say buy and rent, we're talking about an investment property or
Sounds like an investment property, a rental.
okay. Yeah, so let's talk about that. So when we get into using the all-in-one for an investment property, it's really going to be a question of how do we specifically utilize the rest of what's going on in your financial portfolio. So oftentimes we get into a question of, do I use this on my primary? Do I use this on my rental? Do I use it on both? It's going to be a question of exactly what your budget looks like. But let's just say that this would be your first all-in-one. The benefit of this would be that you have two approaches on it. Number one, you use that investment property in a silo. Let's say that you're at 50% LTV and you've got really, really good cash flow. Well, then what you could do is you could take an all-in-one on this investment property and run all of your rents through the all-in-one. And because of your excellent cash flow, it's going to reduce that 50% principal balance on that rental property at a much, much, much faster rate than a 30-year fixed product. And very quickly, you'll have that property paid off. Well, what does that do for you? It increases your cash flow. And guess what you use that cash flow now at that point? You refi your primary residence into a new all-in-one. You take the cash flow from the rental, and then you expedite with velocity banking all of the pay down of that primary residence. Or if you don't want to pay down your primary residence as quickly as possible, you could leverage the cash flow from that investment property into a whole life policy and use infinite banking, right? You could build wealth that way. So all it would do is it would expedite the process of paying off that debt to allow you to leverage that cash flow for some other purpose.
How long does it take for the loan process from the time of application to obtaining the loan?
There's the easy way and there's the hard way. What I always say, the easy way is we get a couple vials of blood, and you're good. The hard way is that you have to fill out an application and you send us your documents and we have to comb through every part of your life, because the great days of 2007 and 8 allowed for people to buy homes with a pulse. And now the government forces us to collect a bunch of documents. So I apologize in advance when we ask you for 2 months of bank statements, maybe a profit and loss, but it's the standard qualification process as any other mortgage. It's typically a 30-day process from us receiving all of your information. Now, obviously, if we happen to find out that there's some other property that doesn't show on your credit report, you have all these other debts, it's easier for us to get all the information up front, because our goal is to help you get into something like this as long as it mathematically makes sense. And the more we can get up front, the faster we can move through the process. And that's kind of just the standard time frame. Now, from when we close during COVID, when there was a whole bunch of chaos going on and people working from home, from the moment you close it during COVID, up to 60 days to get your banking information. Now, that's worked its way down to about 3 weeks to 4 weeks. However, they still say it can take up to 6 days, purely because I guess at one point it went there, so they always have to mention it, that it could potentially be that long. So from to you're getting your bank account, call it 2 months.
All right, very good. Jeremy said, do you have a first lien product that's based on the renovation value of the property? They're a few months from starting construction, finishing up the architectural rendering shortly, and would like to obtain a first lien HELOC to use the funds for the renovation.
Yeah, so we have a first lien construction product. Harrison, can you clarify, can we use it on a renovation process, or is it
No,
just
we
around
wouldn't be
that?
able to
Okay.
utilize it on a renovation
Yeah,
process.
so we don't have it for a renovation, but if you're building, we do have a first lien HELOC for a construction loan. The benefit of that obviously is that your appraised value of the to be built property is what would dictate your line amount. And you could start paying the construction draws to reduce your overall principal load while construction is going on, which is a huge benefit. So your overall principal balance would remain lower than if you were waiting, like in a traditional construction loan, until the end to refi it into a permanent loan. So we do have a construction product. We don't have a renovation product, but that would be another one of those things that we pursue for solutioning in the next 12 months, like Harrison was alluding to earlier.
I mean, part of that though is if Jeremy, if you haven't done the renovation on your property, you could do if there's enough in the home, you could technically do the all-in-one on the property now without taking advantage of the new value, use the line of credit to renovate the property, and then I guess you could come back. I bet you that I have a lot of questions on maybe some ways that you could go through that if you're just trying to look for or financing for it, or if you have the ability to pay for it all yourself. Kind of curious on that. But that there are so many ways you could kind of be creative in that concept.
Yeah, an example of that, Harrison, we did this with our current home. When we sold, we just got really lucky. When we sold our starter home after living in it for 7 years, we had gained some of the appreciation that occurred in the market in 2020, 2021. We bought our current home with an all-in-one, dropped in our proceeds from the sale of our home. So we had a significant amount of room in our line of credit. We then renovated the home that we bought, increased the value by redoing the kitchen and improving the backyard, et cetera. And then we refinanced to a new all-in-one. Well, guess what? The value of the property had increased significantly because of those renovations. And so now we had an increased line based on those renovations. And so there's, like Harrison said, there's lots of creative options that you could leverage depending on what your equity position and situation is now.
All right. Let's see here. What do we got up next? Can you get into a little bit more detail about the sweep account, the
Yeah.
sweep checking account? We've had a few people asking about that.
Yeah, so the sweep account is kind of like it is the vehicle of this all-in-one loan. So again, we showed you screenshots of the checking account and we showed you screenshots of the loan. The sweep account is really just the activity that the checking account does. Every time you earn money, it gets deposited into your checking account. Think of the checking account as the verb of your bank at the end of the day. It is the thing that does the doing. It pulls money out of your line of credit and it's the place that you put your money into. Sweeping effect, it's not necessarily like it's its own separate checking account. It's just the thing that the checking account has the ability to do. Without you being involved, except for in Texas, it automatically takes every dollar in your checking account and sweeps it from your checking into your mortgage balance. They call it an offset account as well. That's kind of how typically they describe it over in Europe or Australia. Again, it's just taking the money in your checking account, it moves it automatically and offsets the balance on your mortgage, which is also going to be the thing that calculates your interest.
Okay, cool. While you guys are hitting the next question, so I'll put that in the comments. Just give me about 2 more minutes.
Yep, and I'll keep reading the questions. So people say, hey, what options do we have in Texas? So there are Texas products, the all-in-one there. Yes, you have the $4,000 minimum draw. The way that it works in Texas is that you do one of two things. You have to just elect for the money to move from your checking account to your mortgage. Slight manual movement at the end of the day, but it works exactly the same. There's two philosophies between between using it on Texas. And this is only for primary residence. So if you have an investment property, it works the same as it does in any other state in the United States. But for primary residence, we see sometimes people just leave a balance of $4,000 in their checking account. So that way, if bills come, they don't need to move all this money over and then move the remaining balance. It really just kind of depends on what you're looking at trying to do. You could move the money into the checking to pay the bill of and move the 3 grand back, or you could just leave 4 grand in your checking at all times, and then every other dollar you sweep over. Other than that, the functionalities were almost identical to any other state. So I think that solves hopefully Beverly and Janet. There are options in Texas, and it's essentially the exact same thing as any other state at the end of the day. Dex all-in-ones are interest only. That is kind of the benefit of this product. So every dollar you earn, people say, well, how do you down if it's interest only? Well, every single dollar you earn gets applied to your principal balance, and then your payment is only going to be based off of what that balance works its way down. So the benefit of this product is really going to be helpful more towards people that are saving 15% of their income on a monthly basis.
What was the percent? 50 to
15 of their net
15.
income is kind of a good place to look at. Now, somebody has there, that's like a generic number at the end of the day, because I think most people aren't going to buy well out of their range of what the income, but there are some times where people say, oh, I make $100,000 a year and I live in a $400,000 house. 15% of their income is certainly going to be very attractive. And even in that instance, they could save 10% of their income. So it's just really kind of dependent. That simulator that I showed you, plenty of information about how to walk through it for yourself, whether it's purchase or refi, cash out, or in Texas, self-employed too. There's every answer in there that hopefully should be able to guide you guys through all of that.
All right, cool. So if you have multiple properties, can you consolidate into one loan?
Yeah, but well, sort of. So the way that you the way that you would do that, each all-in-one is collateralized against one property. We currently don't have kind of a commercial blanket style all-in-one loan. Now, hopefully, we're
Not
moving
yet.
that direction. Yeah, not yet. Hopefully, we're moving that direction. But currently, each all-in-one loan is collateralized against one property. So what my father-in-law did when he refinanced to the all-in-one is that he had a rental property with a small principal balance, and he had his primary residence with like a medium-sized principal balance. He did the all-in-one on his primary residence. And so let's use real numbers. His property was worth $500,000. He owed 220, and he got a line of credit for 400. So he had $180,000 available to him in equity. He had a principal balance on his rental property of $80,000. So he used equity from the all-in-one loan to pay off the mortgage on his rental property. So he owns the rental property free and clear. And now the principal balance on his all-in-one loan on his primary residence was $300,000. He wrapped the principal from both properties into one loan. And then he used his cash flow, both from the investment and from his income, to pay down that $300,000 at an expedited rate compared to a 30-year fixed loan. So do we have multiple kind of blanket style loans? Not yet. But are there ways to leverage equity to have multiple properties rolled into the same loan? Yes, the numbers work.
Interesting. Very cool. Let's see here. For your fee, does that include the appraisal and closing cost?
Great question. So the total figures you're going to see in costs, I'm gonna kind of break it down in just sections. You have the cost of the interest rate, the margin. That's the thing that you get to pick. You can choose a lower margin for more of an expense, higher margin for less of an expense. At the end of the day, it depends. Goals are that can be determined as trying to figure out which one makes the most sense for you. The cost on that alone could be anywhere from 0.25 all 3%, depending on credit score and so on. So if you have a $200,000 mortgage, it could be, $1,000 up to $6,000. Middle of the road option is going to just be a cost of 1% of your loan amount. So let's just say $2,000. You next have our CMG fees. The fees, because for us, $1,500. Appraisal can range from 600 to 1,000. So you're looking at maybe 750 in the middle, and then fees. And that's all the fees that you're going to see on this transaction. So yes, it does include appraisal and the closing cost. You can wrap all of that into the loan.
Okay, cool. And then somebody asked kind of along those lines, how do you guys get paid for your services?
Great question. So at the end of the day, we're value add of changing the banking institution from wherever you're at to this new banking institution. In fact, the compensation that we make is going to be really based off of your specific scenario, because they're going to present value dollar visual of saying, hey, this person has this much coming in to their checking account, which now is going to be over at the bank. And essentially we're kind of trading it on open market and securitizing it just like any other 30-year mortgage. And they kind of look at this overall benefit of the individual. Like Fannie and Freddie, we make bonds and securitize it. We kind of do something similar to that, but on kind of the private side.
All right, cool. A couple of qualifying questions. What's the credit score required for this?
700 for
700
primary.
for primary.
Yep, and 720 for
And
investment.
720 for investment.
Okay. Very cool. And can they use it to get a second house with this loan, or third house, fourth house? Can they use this as the mortgage?
So yes and no. We like to lean towards yes, but there's some qualifiers for that. You can have up to, and Harrison, correct me if I'm wrong here, up to 3 all-in-one loans. One for primary, one for second home, one for investment.
Yeah, pretty much. One for primary and 2 for investments. But yeah, technically the max is going to be 3.
Right. But if we're using this style of banking and we're increasing the velocity of our money, we're paying down the balance, what often occurs is, especially on a primary, when you're funneling all of your funds into this all-in-one loan to reduce your overall principal balance, what happens pretty quickly, this is kind of the flow of this. We'll talk about the Oreo model next week. That's Harrison's idea, not mine. But we'll talk about the Oreo analogy next week. What happens oftentimes is you see a significant speed of principal reduction upfront in the first 2 to 3 years. And then pretty quickly, people are like, oh my gosh, this account is saying I have $200,000 or $300,000 worth of equity. What could I do with that? And then they call me back, or they call Harrison back, and they say, can I buy an investment property with my equity on the all-in-one loan? And we say, sure you can. So the all-in-one loan, although you can only technically get 3 total loans, you can leverage the all-in-one many, many, many times over. Like Joe talked about last week, he said he's paid his HELOC off 4 times over. That's the idea. You leverage the equity that you create in the all-in-one to acquire other assets, and then you pay it back down, and then you do it again, and then you pay it back down, and then you do it again. And pretty soon you're holding cash flowing assets that are paying you, and you get to a place like Joe where you don't have to go buy assets. You just start holding paper. You lend your money to other people, and then you start making monopoly money, like in where you collect 12, 15, 17% simply for loaning. There's no tenant management. There's no risk in the market, right? You're just holding paper. And that's the ultimate goal, is to get to that place. So the all-in-one loan can start the process to get to a place where you're simply collecting interest on money that you've now paid down.
All right, cool. We got some really good questions coming in, so I'm gonna keep this rolling. But just to clarify, guys, I put a couple of links over in the comments. So there's one that you guys can connect directly with Greg and Harrison if you just want to dive in real specifically just on the all-in-one. What I would recommend for most of you, though, is I would recommend you guys scheduling with Joe. Joe's been doing this concept along with infinite banking for over 16 years now, and is our in-house expert on this. So he can really talk to you about your overall financial situation, what you have going on, kind of pre-qualify whether this would make sense for you or not before you go and connect with Harrison and Greg, and kind of talk you through all that stuff. And then also what it could look like with IBC. Not necessarily that you need to or should do it with IBC, but if it makes sense for you, Joe will be able to identify that and recommend the next best steps for you. So I'd highly recommend getting that call scheduled first with Joe, and then you can move on to talk with Harrison and Greg to get that application going. I also did share Harrison's YouTube channel over in the chat. And on that channel, if you scroll on the page, you can see where he's got the all-in-one calculator and some other really useful tools right on there for you guys. So just wanted to make note of that, because these other questions are going to be coming up. Now, Craig, I got one question for you real fast before we move on with this all-in-one questions. What is more fun, watching a tennis match or watching paint dry? I'm just kidding.
I actually enjoy watching the paint dry as they play tennis.
Okay, all right. So they just painted the suite you're in, and which one's more exciting? I don't know. I'm just kidding. I like tennis. I'm just having fun. All right. So lazy cash in a money market versus paying down the HELOC with a balance of 200,000 versus moving all the lazy cash into a policy and then paying down the HELOC, trying to understand the best way to structure this. So I'm going to say just schedule the call with Joe. But
Yeah.
Joe, do you want to hit on that real fast, maybe just quickly?
I'm trying to pull it up and read it. I caught some of it when you were talking, but I can't pull it up.
It's the top question in the Q&A box. You have that one open up.
There it is. Okay. When the money is starting inside of the HELOC and then we roll it through the policy, now we're going to pay ourselves first. By paying ourselves first, we're going to start that and then paying down the HELOC. When the money paying back the HELOC and paying back the policy, the asset is the policy because that will make you money irregardless if we're taking the money out of it and using it. But the money in the HELOC is a straight 7-8%. That would be the liability. So we would always want to put the money and pay back the HELOC prior to paying the policy. I think that was the question.
Yeah, and I would just connect with you on the phone so you guys can get into it a little bit more. The next question, kind of same thing. Can I tap into my equity to fund the IBC?
Of course.
Absolutely, you can, if it makes sense financially.
It depends.
Definitely want to go through the numbers with you and
Stephen, and maybe can I just throw in 2 cents on something like that? I think, I recently bought a vehicle, and it kind of conceptually means very similar to what you're walking through. I should have opened a policy and put the money that I was going to use to buy the vehicle into a policy, and then pulled the money out of the policy and go and buy the vehicle. Because
Yep.
to me, let's say that vehicle wasn't a vehicle and it was more of a house. Now I have money growing in a policy, and I have money growing in the equity of the home. So I took $25,000, $30,000 and really turned it into 2 investments that equal $60,000. So mathematically, I would say it would make more sense to go pull money out of if it makes sense, pull money out of the money market, put it into a policy. I guess technically, if you really wanted to, you could then take the money out of the policy and put it towards your mortgage if it meant that your payment was, the arbitrage of the difference. There's so many ways you could get into it, and then you can get real nitty gritty. And it seems like Joe obviously agrees with that.
Yeah, just depends. But
Just
yeah,
depends. Correct.
but absolutely with you, out of the HELOC into the policy and then buy it.
Yeah.
That was my aha moment.
Yeah, it's amazing.
All right, cool. Is this thing available for leasehold properties in Hawaii?
I believe that there shouldn't be any issue with leasehold properties. Most properties, from my understanding, is that they are leasehold in Hawaii. And I think that and Lily, obviously correct me if I'm wrong, 99-year-long leases for the most part. I think that we just need to make sure that the lease doesn't end before the ends, and I think that we're good.
Okay, cool. That's interesting.
Yeah, it's pretty interesting. Hawaii is very fun. There's like lava zones that you can't do financing on based off of like flood zones, but where lava flows, it's exciting.
Wow. Yeah, pretty wild. We have the hurricanes here in Florida. They got the lava.
Yeah.
Why, right? All right. Lexi says, I'm retired. Awesome. And my income is Social Security. Will this ultimately reduce the percentage amount I can borrow? My home is paid off. So retiree on Social Security, would they qualify with a paid off home?
Yes, the paid off home, effectively what we're going to do is we're going to take all revenue sources, Social Security in this case, and we're going to say, what is your debt to income ratio based on your income, which is in this case is Social Security. And then based on that and based on your personal preferences, we would create a line of credit that aligns with that debt to income ratio and the limits that are on the product. So let's say your home is worth $500,000, but based on Social Security, your line of credit can only be up to 350 instead of the max of 400. That would be the restriction. So it's going to be based on what your income is versus your debts, and then where that caps out inside of our guidelines for the all-in-one.
Do you guys run up to a 45?
43.
In some cases 45, but most of the time it's 43.
Yeah.
All right.
But the nice thing is that for folks that have assets either in retirement-based accounts or liquid assets that currently is just loitering in a savings account or a money market, we have an asset depletion function in this loan that isn't present in a typical conventional loan. So oftentimes we can increase qualifying income based on liquid assets or market-based assets.
And in some instances, like a lot of typical adjustable rate mortgages base it off of rate plus 1 or something. We don't do rate plus. We off of the rate at the time that the transactions originated. So it could be, I guess we could do +1 and then go up to 45. That's what typically a lot of people kind of get rid of all of that and just keep it a strict hard number.
Greg, explain to our people a little bit more about what you were talking about, that the brokerage.
Asset depletion.
Yeah, so if they have a brokerage account with, say, $300,000,
Yeah. So what we would do in that instance is if we needed additional income to increase how much we could borrow, and they had a brokerage account worth $300,000 and they were not, say, of retirement age, what we do is we say, okay, $300,000 is a lot of money. Let's amortize that $300,000 over a 10-year period. So if it's $300,000 sitting in a money market, we divide it by 120, 10 years, 12 months per year. And that monthly number gets added to qualifying income. Because effectively what we're saying is, look, that $300,000 that's over in this money market, that's money that could help pay a mortgage in a pinch. And so we're actually going to allow the client to utilize those assets to qualify for more because they are more qualified. They've got a safety net in that money market account of $300,000. If the money is housed in a brokerage account, like you mentioned, something that's market based, and the borrower is not retirement age, which by the loan definition is 65, we're going to give it a 30% haircut, right, for volatility in the market. So we'd allow for 70% of the total amount. So if it's $300,000 in a brokerage account, we'd say, okay, $210,000 is available. Divide that 210 by 10 years, and that's what additional qualifying income is for this loan.
Exactly. I just wanted the people to hear that. And what kind of accounts are these? Just brokerages or 401ks or what?
Yeah, so certainly any sort of liquid assets, checking, savings, money market CDs, brokerage accounts like just a regular, like a Schwab account or an Edward Jones account that isn't associated with retirement are certainly eligible. IRAs are eligible. TSPs in some instances are eligible. 401ks typically are eligible. It gets a little sticky on a 401ks depending on what type of property, primary residence versus investment, based on hardship withdrawals. So we get into the nitty gritty of that, but generally speaking, we can utilize those accounts, especially on primary residence.
Awesome.
All right. And just to clarify, the Hawaii, they were saying that there are some, where'd that go?
I just responded. So there's 7, 10. Yeah, again, the Hawaii one, if the leases have been extended, again, this is like a very situational thing. It's not always just like a cut and dry, oh, if it's not for this long, then it doesn't work. It's, well, if it has been extended in the past, then we can kind of make sure that there's a little bit of due diligence that we do at the end of the day.
Yeah, I just thought that was interesting. I didn't know Hawaii was like that.
Yeah, it's very interesting. There's a lot of really crazy things that happen all over the country.
Yeah, for sure. Do you have to close your present bank account and use only your bank?
No, don't close your present bank account, my checking account from my Wells Fargo. I just changed the direct deposit of my income. But if I ever did need to go pull out a large sum of cash, then yeah, I can move it over to my Wells Fargo account. I'm not saying get rid of your current relationship. It's just let's change the banking relationship to something that benefits you more than the bank, as opposed to having the bank be the primary benefit associated with the product, like most current banking institutions.
All right. Can you do an all-in-one on a rental property that's in an LLC if it's not your personal name?
So no, not right now. Again, that's one of those things that right now we are, I want to say restricted, but we're currently adhering to Fannie Mae guidelines. Fannie Mae doesn't play nice in the sandbox with LLC holdings. So currently we don't have an LLC option. Now, if you have a living trust, that would be something that you could vest in. And inherently the question comes up, well, could I get an all-in-one in my personal name, then quit claim deed to an LLC after the fact? Because that happens a lot on conventional loans. With the all-in-one, it's not advisable. More than likely that loan will be called due if you change vesting. So what we advise people is either live with the fact that it's in a personal name and get an umbrella policy to cover your liability at an additional level, or look for a living trust or create a living trust if that's an additional method that you could agree with. But unfortunately, right now, we don't have the ability to vest in an LLC.
All right, cool. And I know we talked about the co-ops in New York. Do you fund condos in New York?
Again, it kind of depends depending on that specific property. But if it's considered residential and you can do any other regular conforming product on it, then yes. Currently, we're not licensed in New York. It's like one of the few states that we're not licensed in. So we have to be kind of tricky about what we can communicate. We do have somebody that we on our team as well that's just not on the call. That is available in New York though.
All right, cool. Let's see. They're asking, we have Prop 13 in California. Taxes 1,600 a year. House is worth 1.14 million. They're retired. Mortgage with Crooked Wells Fargo. Lived here over 48 years. You have a great system. Paid 79,950 for the house in 1977. Wow. Very cool.
Beautiful.
Yeah.
Hmm.
How soon until you guys get that blanket loan?
I would say that we're at about fastest case scenario, which is kind of hard to guesstimate a lot of this. We're easily at least a 12-month time frame. However, TC, if you want to shoot us a message, it's possible that we might have like a kind of like an alpha version of it. If you're interested, I could put you on the list and maybe you could be one of the first people. So feel free to reach out to us and we can kind of get further into that and we can learn a little more, propose it over, and work on potentially kind of like an alpha or beta version for it.
Okay, cool. And then I had several people again just asking about using this to buy their primary residence as opposed to a conventional mortgage. Like they don't have to get the conventional first and then switch over. You can use this right from the get-go, right? So maybe just
Correct.
what that process looks like though. Is it exactly the same? Or?
It's exactly the same. Yeah. So the only thing that you're going to notice on a primary residence or any purchase transaction is that you're going to see all those same closing costs that we talked about. However, there's one item on there called an initial draw adjustment. That's just a really fancy way of saying that you need to make your first deposit into your bank account. If you go to Wells Fargo or Chase or whomever, they're going to say, hey, you want to open up a bank account? Great. Give us $100, give us $1,000, whatever their requirements are. For this product, we want you to have a deposit of 1% of your amount as your first deposit into the bank account. Kind of thinking of it as taking money from my left pocket and putting it into my right pocket. It's not a cost filling your bank account just like any bank account requires, and that's at the closing table. Still your money. Once you get access to your account, you have access to using it. It's just your deposit.
Okay. Are you licensed in California?
Correct. Yes.
All right.
There was a
And-
question about HECMs versus all-in-one for retirement age folks.
Yeah.
Harrison, do you have a kind of a policy or a strategy you utilize to clarify whether a HECM or an all-in-one is a better option for someone who's retired on fixed income?
I mean,
What is a
Reverse mortgage.
Yeah, reverse mortgage. And I mean, realistically, when thinking about reverse mortgages and all-in-ones, the all-in-one really is like a reverse mortgage for people below age. Has a little bit of flexibility, slightly lower costs. The benefit of having a reverse mortgage is that you can never legally, because of it's placed on the product, owe more than what the value of the home is. Now you have to have certain debt to income ratio requirements and so on. Sorry, not debt to income, but loan to value requirements. But the benefit of that product is to say, hey, look, you're on fixed income. You don't need to worry about a mortgage again. Yes, you still need to pay your taxes and insurance when those come due, but over the course of the year, substantially cheaper. Now you can go and kind of not need to worry about this expense over, and the balance on your home goes up. Again, they still own the home, and then the family has the opportunity to buy that home out from the loan that they're in time that they pass, and it's still in the family. They can get out of, or they can sell it depending on what they're looking at. But realistically, 15% retained funds at the end of every single month is going to be a big proponent. Depending on what that retirement scenario looks like, it certainly may be possible. It may not be.
All right, cool. Would you say a reverse mortgage is safer due to no foreclosure possibility?
I guess depending on what definition of safer is, because in my opinion, right now, safer means spending less in unnecessary expenses, but safer at a retirement age may be, hey, I want to make sure I still have a roof over my head. So deciding really what the benefit is for the individual, that's kind of a really open-ended question in my opinion. I think that if you have limited funds left over at the end of every single month, you have plenty of equity in your home, you're not interested in having the home paid off because you need to change your lifestyle or downsize your property, then I would say, yeah, stick with the HECM because of the foreclosure item protection. But at the same time, all-in-one for people that benefit from it are overly protected in foreclosure options as well. I mean, I don't think we've had a reported instance of anybody foreclosing on an all-in-one, and that's because we have such strict requirements associated with individuals getting into this product.
Yeah. Plus, you got
The
to say
other,
heck all the time, which is like, oh, I'd rather have the
Yeah,
AO, the AO, the all in one. Like, it's more fun.
yeah.
two comments just to piggyback on that, if it's all right. Number one, CMG has all conventional loans, all Govy-based loans. The HECM or reverse mortgage is an FHA product, so we do offer it, and we're licensed to do so. We're not going to funnel people to the all-in-one exclusively if it doesn't make sense. If a HECM or a reverse mortgage makes more sense for your scenario, that's what we're going to direct you towards, right? Because ultimately what we're trying to do is to be as efficient and as helpful as loan officers for your life. And if a HECM makes more sense, great, no problem. That's what we'll send you towards. We're not predisposed to funnel everybody towards the all-in-one, because the all-in-one is not for everybody. It is kind of an exclusive product, and that's by design. The second comment I would make, go ahead.
I mean, even to kind of piggyback off that, if it doesn't make sense to find the solution for you, and if somebody has a better option, I would way rather put you in the direction of the better solution just for you. I mean, out of the people that we've helped get into all-in-ones, I've pushed out saying you shouldn't do an all-in-one, and you should actually look into this option. It might actually be cheaper for your specific scenario than us. Now, use us as like a liaison. I mean, we're here to help you. It doesn't cost you anything to talk to us. It doesn't cost you, hey, can you look at what this person sent us? Do you have anything that any questions for us, or any questions that we should ask? I mean, we'll do that left and right, because at the end of the day, we want to make sure we're helping people. That's like the bottom bare minimum.
Yep, correct. And then just as a kind of an aside, an interesting component of the all-in-one that people don't talk about very often, I think we touched on it last week. When you're in an equity position, which you would have to be if you were looking at a reverse mortgage as an option versus an all-in-one, when you're in an equity position, again, let's say you have a $500,000 home and you only owe $100,000. If you have that full line of credit for $400,000 up to 80%, you've got $300,000 worth of equity. From a risk perspective, effectively what that means is, and we wouldn't suggest this, just so we're clear, we wouldn't suggest this, but if you didn't make your interest only payment on your mortgage for 12 months, all that occurs is your interest only payment gets added to your principal balance. And so now at the end of a year, your principal balance, say, is 115,000 instead of 100,000. And there's still significant room until you hit the top end of that line of credit. So from a risk management perspective, you have a really, really, really long runway before you really start to get into any real significant trouble. Now, again, we don't suggest that. If that's the model, probably not the product for you anyways. But if you get into dire straits after you've already done the all-in-one and you have some equity, it's actually more beneficial than a regular 30-year fixed product, because you have that equity position to help cushion some of that time. So from a risk perspective, if you do have that equity position, you actually mitigate that risk in the all-in-one better.
All right. Well, if I had a microphone, I'd drop it, because we just ran out of questions, and that was so. With that said, we can, unless anything else is coming through, we can kind of do around the horn. If anybody just wants to share any last words, and just one more time, I'll drop the links over in the comment box. I would definitely start with the call with Joe. Let's work through and make sure this is making sense and how you could possibly use it with IBC, and then he will pass you right over to Harrison and Greg to get applied for that and get that process going. If IBC makes sense as well, or a new policy, we can start underwriting at the same time and get everything rolling forward. Or if you just need to connect directly with Harrison and Greg for something specific to all-in-ones right away, I'll share their contact information as well, their call calendars and email, so you can reach out either way. But I'll do a little around the horn. Craig, if you want to, any last words you want to add or anything like that, and also maybe what we're going to get into next week as well.
Yeah, I'm not kind of noisy in here, so I'm going to go off of mute here, or go back on mute here real shortly. But next week we're going to be talking about how to utilize this for. Well, I'm not going to steal Harrison's thunder, but he's got a cool little illustration or name for what he talks about how we can use this. But think about how you can use this for debt, how you can use this for investing. So there's a lot of different practical uses. So anyway, I'm going to be signing off here. I'll just watch the rest of the show.
Cool. Thanks, Craig. Have fun at the tennis tournament.
I mean, watching paint dry.
Yeah, go ahead, Greg.
Yeah, man, I'd say the biggest thing, guys, is that, and we talked about this last week, all of the people on this call are doing this because the scripts that have worked for decades financially in America don't work anymore. And now what we're having to do is we're having to relearn what's been taught to us by our parents or grandparents and look at new ways to get ahead, new ways to pay off debt, new ways to build wealth, new ways to leverage old financial instruments. And so again, credit to you guys, everybody that's on this call, for being willing to have a mindset to learn something new. Because when you can do that, you can change the trajectory of your life. And these products literally can do just that. And the folks that are on this call on the panel, we really do want to help people lean into that mindset and lean into that kind of transformation.
Very cool. What do you think, Joe?
Just to go off of Greg, it is all about mindset. It is, because we're not taught this. They don't teach us this in school. We have to learn this. I came up with this. I had 2 mortgages in front of me and understood what amortization was and wanted to be in simple interest. And that's how I started. And it's the mindset. If you're open to it, to understand it, to get out of the amortization, to get out of the bank being in control and actually you being in control with the HELOC, then it'll open up different doors for you.
All right, very cool. And Harrison, George, I'll let you have the final words here today.
Yeah, no, I appreciate it. I mean, guys, at the end of the day, it doesn't matter how much money you have. It doesn't matter who you know, and it really doesn't matter how fast you pay your home off, because realistically, none of us have another second of time on this earth. And if you can have a little more time with the people you love and the people that you're being around, and if that means that you can take a little bit of stress off of your plate by putting it by paying off debt, which is, Chris mentioned in the beginning of his video, one of the most stressful things about life right now is having debt. It's growing at an exponential rate. So if we can figure out ways of getting more of your time back, spending time with the ones that you love, as opposed to spending time figuring out how you're going to make your next bill, that's what we genuinely care about. And we want to figure out ways of putting more time, not back into your guys' life, but more time back into your pocket. So we really appreciate you guys giving us time. And if you need anything from us, obviously you have all the links to reach out to us. We really appreciate everything that you guys have provided for us today, all the questions.
All right, awesome, guys. Well, appreciate everybody being here. Hopefully you took something out of this. It was a little bit different of a wealth webinar than we usually do, focusing on the infinite banking concept. And when you learn how this strategy works along with IBC, it can become a very powerful financial strategy for you. And again, that's what HELOC Joe has been doing for over 16 years now. Schedule a call with them, see how this can help you if it makes sense financially. If not, we'll guide you in a different direction. That's what this is all about, is making sure this is something that is going to benefit you and your family and generations to come, quite honestly. So appreciate everybody being here. Harrison, Craig, Joe. Thanks, guys. If anybody else has any other questions, we'll be on the YouTube channel, YouTube at the Chris Naugle, as well as streaming on Facebook later today at 4:30 Eastern for the Ask Me Anything happy hour. So join us there. Otherwise, we'll see you same time, same place, wealth webinar next Wednesday for part 3 of the all-in-one CMG BYOB series. Have a great day, guys. Thanks so much. See you next time. Bye.